Let's get right into it. Guy Adami, not the kind of way we really wanted to end the week, I'm sure.
No, not a great end of the week, and you hit all the salient points for sure. And none of us are trying to be Pollyannish here. We're not trying to sort of give all the silver linings. But if you're looking for one, and Tim mentioned this last night, the fact that the VIX continues to sort of move lower now, I think with a 46 handle, although obviously the market can continue lower, I think taking volatility out of the market is going to assuage a lot of concerns. So that's a good thing. There have been some winners and losers, and we were trying to talk about it last night. We got usurped for good reason, but some of these retailers have done very well. I mean, Dollar General, for example, is within a whisper of an all-time high in that stock, which is remarkable if you think about it in this environment. And the fact that there seems to be some stabilization, another word I'll use again and again, in the bond market. I think those are all good things under a backdrop of a broader market that seems to want to sort of just drift a little bit lower from here, Brian.
Yeah, and Tim Seymour, you know what drifted lower is the NASDAQ. I mean, with the exception of Microsoft, which squeaked out some gains for the week, the big cap tech stocks and the QQQ, they're looking weak.
Well, they slight up underperformance this week, and I do think it's something we have to watch. And we've talked about where the leadership of the market has been, and that's been a concern. Dan's mentioned his MAGA stocks, and I think if you want to see the market taking the next move lower, it's going to absolutely going to come, I think, in the form of Microsoft and Apple and Google and Amazon to a lesser extent. But look, I think there had been significant outperformance, almost 800 basis points this year on the triple Qs to the S&P. So let's just watch that. I think your other risk measures this week, the dollar, I'm afraid, looks like it's reasserting itself. And we've had, effectively a 2% move in the dollar off of those lows. So it's taken back some of that move to almost to the 18-year highs. We have to watch that. Treasury yields, although Guy talked about the volatility, the extreme volatility in the Treasury market is lower. Bond yields are telling you, again, what small cap told you, which is that these are growth measures of the economy. And although if you had said a month ago you were going to print 6.6 jobless claims and an unemployment number today that you saw, and the market did what it did, maybe this is a small victory. I think we understand why these shocks are here. The question is the duration of the shock, obviously the healthcare crisis we have.
Yeah, and J.P. Morgan Chase out with a note today saying they could see a 7 million jobless benefit claim week next week, which would take us to 17 million unemployed in just 21 days. Truly insane. Dan, let's stick with small caps. Wow. Monday night, I think it was, you said if you kind of want to know the direction of the economy, look at the small caps. It's been a long week for everybody. I don't want to pile on, but if the small caps are telling the story of the economy, it's not good.
No, it's not, Sully. I mean, listen, Guy and Tim are trying to be constructive. I heard the term small victory. I heard the term silver linings. The fact of the matter is, when you think about, and I just don't want to talk about the health crisis, that's something that scales the hell out of all of us right now. But when I think about the economy and I think about the stock market and I think about the stock market as a lens for how it's viewing all of these things, and particularly like you just bring up the small caps, there are no silver linings. So if you're looking for when's the bottom, it's not happening in April 2020. It might not even happen in 2020. And I just can't phrase that. I would love to be more optimistic about the economy, and I'd love to be more optimistic about the stock market. The stock market is fairly insignificant in the grand scheme of things, and I'm just telling you that there are no silver linings. We are going to break the low from March 23rd down at 2,200 in the S&P 500. The only thing that you have to decide right now is how much cash that you need, how much cash do you want to have free from an investment standpoint when we do break those lows. And the other thing, I've just been saying this time and time again over the last few weeks, is that there are no V-bottoms. It may V-bottom at some point, but far, far from now. So in the meantime, be prepared for a long slog, both economically and in the financial markets.
Yeah, and that's a great point. And Steve Grasso, listen, I mean, it's a fool's errand to try to time the market, especially for the casual investors, got a 401k, maybe some stock funds, some ETFs. So should they be dollar cost averaging sort of back into the market if you're a long-term investor now? Or literally is cash the only, and maybe certain bonds, the only place you want to be?
Yeah, so the truth is none of us know where the true bottom is, and I agree with Dan. I think we're going to take out those lows. I think Tim and Guy probably agree with that as well. But the truth is, I don't know whether it's 1,700 or 1,500 in the S&P. And for that matter, if you're a long-term investor and you're looking out 5 years, 10 years, you should definitely be buying stocks on the way down. You don't have to leverage everything in right now, but what has the market taken its lead from as of late? It's been oil, and I think that's what disrupted the overall flow today. I think it could have been much worse today if not for that oil meeting that took place at the White House. Oil's up 50%. That takes a lot of these small cap names up with it, but oil is such an insignificant part of the overall indice that I don't think that's going to be the saving grace. So ultimately lower, but you're going to get these little rallies within this bear market that we're in currently.
As all four of you have said, the biggest bounces come during bear markets. That's when you get these violent snap back up here.